It's 3:47 a.m. in Singapore. A commodities trader named Marcus is staring at his Bloomberg terminal, coffee going cold beside him. The number blinking on his screen doesn't match anything in his model. 12 hours from now, that number will be on every financial news site in the world. Right now, it's just him and a blinking cursor, and a decision that could make or break his year. Today, we're talking about the most dangerous moment in oil markets since the 1970s, and more importantly, what it means for your portfolio. Here's what you need to know. Brent Crude is up 42% since the Iran conflict began. That's not a blip. That's not a spike. That's a structural shift in global energy. WTI, West Texas Intermediate, the American benchmark, is up 47%. And right now, a tiny coral island most people have never heard of sits at the center of it all. Kharg Island. Say it with me. Kharg. Because if you're an investor, this is the name that could define your 2026. Let me set the scene. Iran exports about 1.5 to 2 million barrels of oil every single day, and 94% of that oil flows through one place. Kharg Island. It's a small coral outcrop in the Persian Gulf, about 15 miles off the Iranian coast. The water there is naturally deep enough for the world's largest supertankers to dock directly. That makes it irreplaceable. You can't just build another deep-water port overnight. Iran's entire oil economy runs through this single point of infrastructure. On March 14th, U.S. and Israeli forces struck military targets on Kharg Island. Let me be clear. The oil infrastructure itself remains intact. For now. But here's where it gets dangerous. President Trump has explicitly warned that if Iran interferes with shipping through the Strait of Hormuz, oil facilities become targets. The Strait of Hormuz. This narrow waterway, barely 21 miles wide at its narrowest point, is the most important choke point in global energy. 20% of all global oil trade passes through this single channel every single day. That's roughly 17 to 20 million barrels, just through this one narrow passage. If those exports get disrupted, whether by military action, mines, or just insurance companies refusing to cover tankers, the math changes for every portfolio on the planet. JPMorgan's analysts have run the scenarios. If Hormuz exports face serious disruption, they see Brent Crude potentially spiking to somewhere between $100 and $120 per barrel. Now, I want to be careful here because this is where people get burned. A price spike is not a prediction, it's a scenario, one of several. Here's the JPMorgan analysis that really matters. In their base case, the S&P 500 could slide to around 6,000 if current headwinds intensify. That's roughly a 10% pullback from recent highs. But their worst-case scenario? If the U.S. were to seize Kharg Island directly, a recession becomes, quote, highly likely, and stocks could drop at least 20%. That's the range we're working with. Best case, elevated volatility and a modest correction. Worst case? Well, you're looking at a genuine recession scenario. Let's talk history, because oil shocks have happened before. And what history tells us might surprise you. The 1973 Arab oil embargo, the 1979 Iranian Revolution, the 1990 Gulf War. Each time, oil prices spiked dramatically. Each time, pundits screamed recession. But here's the thing. Oil shocks don't automatically cause recessions. That's a critical distinction most people miss. The causation is more complicated than headlines suggest. According to Vanguard's research, for oil prices alone to trigger a U.S. recession, they'd need to hit about $150 per barrel and stay there for the rest of the year. And here's the kicker. That alone isn't enough. Vanguard says you'd also need significant financial tightening happening simultaneously. The Fed hiking rates aggressively, credit markets seizing up. In other words, oil can wound an economy. But it usually takes multiple factors to deliver the knockout punch. That's encouraging news, relatively speaking. Now, the government isn't sitting idle. On March 15th, a strategic petroleum reserve release was announced. The idea is to flood the market with extra supply and calm prices. But here's the honest assessment from analysts. Al Jazeera's economic coverage put it bluntly: strategic oil releases may calm markets, but they cannot fix a Hormuz disruption. The reserve is finite. It's designed for short-term emergencies, not sustained supply disruptions. If Hormuz shipping faces ongoing threats, no strategic reserve can make up the difference indefinitely. So, what do you actually do with this information? How do you stress test your portfolio for a world where oil hits $120? Let's get practical. First, and I want to be clear, this isn't financial advice. Your situation is unique to you. But here's a framework. Ask yourself, what happens to my specific holdings if oil hits 120? Airlines get crushed at high oil prices. Jet fuel is their biggest variable cost. Transportation stocks suffer. But energy producers? They potentially thrive. Does your portfolio have that asymmetry? For most people, some energy exposure makes sense as a hedge. But, and I want to emphasize this, modest exposure. We're talking maybe 5 to 10% of your portfolio, not a concentrated bet. If you're considering energy stocks, research suggests focusing on companies with low break-even prices and strong balance sheets, the ones that can weather volatility, not just ride the spike up. Now here's where it gets interesting. Natural gas. Most people are focused on oil right now, which means natural gas might be the contrarian play of 2026. LNG, liquefied natural gas. Export terminal construction is accelerating globally. Europe is desperately trying to reduce dependence on Russian gas. Asia's demand is growing. And here's a factor most oil analysts aren't even modeling yet. AI data centers. Those facilities consume enormous amounts of power. And increasingly, that power comes from natural gas. So while everyone's chasing oil stocks, natural gas companies building export infrastructure might offer better risk-adjusted returns. That's not a recommendation, it's a thesis to investigate. Here's the thing, and I've been thinking about this a lot lately, the worst decision you can make right now is to panic sell equities. The historical data on this is brutal. During previous triple hold patterns, when the Fed holds rates steady 3 times in a row, investors who panic sold and sat in cash missed average rebounds of over 14%. Those who held through it, they recovered fully within 9 months on average. That's not a guarantee, past performance never is, but it's a pattern worth understanding. Now, your situation is specific to you. Your risk tolerance, your timeline, your tax bracket all change the math. But here's what the pattern suggests, and you should verify this with your own advisor. The smart move isn't to react to one data point. It's to know which data points deserve your attention, and which ones are just noise designed to make you feel something. Cash reserves. This is not the time to be fully invested if you have near-term liquidity needs. 3 to 6 months of expenses in accessible cash. That's your buffer against uncertainty. And look, if you're driving a gas guzzler, budget for higher fuel costs through summer. This is not a short-term spike that resolves in a few weeks. The conflict situation suggests sustained, elevated prices. Let me leave you with one more number. Vanguard's analysis says at current oil prices, without further escalation, the economic effects may have only temporary impact. That's the base case, not the worst case. And investing, real investing, not speculation, means preparing for both outcomes. Hope for the best, position for the range of possibilities. So here's your checklist. Stress test your holdings against 120 oil. Check your energy sector exposure. Consider the natural gas thesis. Build your cash buffer. And, this is the hard one, don't panic sell. If you found this breakdown useful, subscribe for more. We cover stories like this every week, the ones that actually matter for your portfolio, not just headlines designed to get clicks. Here's the honest version. Nobody, not the Fed, not Wall Street, not your favorite finance podcast, knows exactly where oil prices or markets are heading in 6 months. What we can do is look at what the data has shown historically, with the full understanding that history rhymes more than it repeats, and prepare accordingly. That trader in Singapore I mentioned, he held his position. The market moved against him for 3 weeks. Then it moved with him for 3 months. Patience. It's the hardest edge to maintain. This is Money Moves Daily. Remember, this is educational content, not financial advice. Always consult with a qualified financial advisor before making investment decisions. Stay sharp out there.